Hey everybody, welcome back. This is Mark with Beyond Profit, a Global Perspective, and we've done a lot of talking on this program about currency values, what causes them, how money supply affects them, and so on. The thing that we haven't talked about yet, though, is how foreign exchange rates can affect entry strategy. That is, if you're working on a global business plan and you want to move a company someplace, you've got to know a little bit about those exchange rates and how that's going to affect your prospects for success. So that's something we're going to talk about right now. As usual, if you're getting value out of these videos, please like and subscribe. Leave some comments below. Let me know what you think. Talk to some other people here in the community. And most of all, let me know if there are other things you'd like me to talk about. Make some recommendations, right? I'd love to make some videos for you to help you out on your educational journey. And share them, right? If it's helpful to you, maybe it would be helpful to someone else you know. Which is better, a strong dollar or a weak dollar? Dollars are subject to the same rules of supply and demand. So if there's a whole lot of it, then that means that the value of the dollar goes down, and that's what we call a weak dollar. It would be strong if there's less of it around. When a dollar is strong, right, there are advantages to that in some ways, right? Inflation is lower because the US dollar can buy more. I can buy more foreign currency because that currency becomes cheaper relative to the dollar, right? For those of you who have traveled overseas before, you know, a lot of places won't take your US dollars, or at least you got to do a conversion of some type. And so if I have a strong US dollar, then I could buy a whole lot more currency. And so I'm taking a trip to Paris or something like that. If I've got a strong US dollar versus the euro, that means I can get a lot more euros, which means that the hotels seem cheaper. Souvenirs seem cheaper, right? Food seems cheaper. So that gives me an advantage. So that means traveling internationally becomes cheaper. Businesses also invest more in international capital and labor through outsourcing. So I'm picking a country, I want to go someplace, right? If I'm looking at the US dollar versus whatever their currency is, I'm thinking about like, okay, well, if my currency's strong, then maybe that means I can get a better deal on a property, right? Or maybe the labor's going to be cheaper there, right? Because my currency's stronger over here. Or I can buy stuff inside that country cheaper than I could maybe to a comparable country when that currency is not as strong versus my dollar. So those are the kinds of things that you think about, right? Foreign goods also become cheaper if you're an American consumer, right? We import more stuff and our trade deficit increases because, their stuff seems cheaper than our stuff. US products then become more expensive overseas. So that is, let's say that there's a lower value of the currency in Brazil, and we're exporting to Brazil, right? Their currency it's going to take more of their currency to buy whatever it is that we're offering. So they're going to buy less of our stuff, or it's going to be more expensive for them to buy our stuff, right? Less of an incentive for them to want to do it. Their own stuff is going to seem cheaper, or stuff from other countries where the currency is not as strong. And that causes more US dollars to go overseas, chasing cheap products, stimulating foreign economies, and generating job growth there. If you're an international business person and you want to move a business overseas, it's great if you've got a strong US dollar, right? If you're an exporter, it's not such a great thing. So some things to think about. Everything's sort of the converse of that with the weak dollar. So when the US dollar is weak, inflation's higher, and because the US dollar buys less, foreign currency becomes more expensive, right? Maybe I'm not going to take that French trip at all because it's just going to be way too expensive for the food and the hotel and everything like that. My US dollar's not going to stretch as far as it would otherwise. So traveling international becomes more expensive. Businesses may invest more domestically because capital and labor will be relatively cheaper in the US versus that other country. or they may just choose another country where the ratio is stronger. Foreign goods become more expensive. Businesses import less. We move toward a trade surplus. It is to say, people are more likely to buy American goods because their currency is stronger than our currency, or at least stronger than it was before. They're able to buy more of our stuff, so more of that money comes back to the United States. As foreign businesses purchase cheap U.S. products, stimulates the U.S. economy, generates job growth here. So, those are the dynamics. Does that make sense? So, how do financiers make money on financial markets? What are the nuts and bolts of that? Well, we have a floating system now where currency values change from day to day. How does the exchange work if you are a tourist? So I, hypothetically, being an American traveler, would go to another country. Let's say I go to Mexico. I trade my US dollars in. They give me a certain number of pesos based on whatever that exchange rate is, and that's the equivalent, or at least that's the equivalent for the day. Things are going to move up and down, and maybe by the time I'm done with my trip, I may end up with relatively fewer dollars per pesos or relatively more dollars per pesos, depending on whether or not that rate is going to go up or down. So if I buy a bunch of the local currency and the US dollar goes down, what happens? I get to buy a lot of cheap dollars and go home with more than what I started with. The system works the same way for investors. Investors invest in currencies by buying and selling them just like they do on the stock market. If the value of your purchased currency goes up, you can purchase more of another currency on the next transaction. It may not work quite so favorably if you don't have a whole lot of money or if you're just planning on doing some traveling, right? Sometimes those fluctuations may not make a huge amount of difference in terms of the investment. But if you're talking about relatively large amounts of money, then it can make a huge difference. I think about, for example, the time that I lived in the UK and I had a Lloyd's account. And when I was working there, I put money in, and then I worked there for a couple of years, moved back to the United States, and then I had to make a decision. Do I want to convert my money back to US dollars? And then I started looking at the exchange rates. Well, at that time, the US dollar was getting weaker and weaker over time. The British pound was getting stronger and stronger. And then I had to sort of make a calculation. At what point would it be a good idea for me to pull it out? And so I ended up leaving it in there for, a year or more, a couple years longer, just so that it would continue to increase in value. Then when I took that money and I converted it back to US dollars, I made a sizable gain on my investment. If you're a financier and you're dealing with millions or billions of dollars, you can make a whole lot of money by doing not very much. Fluctuations also make a big difference when it comes to just conducting business overseas. Like if I have a contract and I'm supposed to deliver something to some foreign contractor, then we have to figure out, okay, so when does this transaction occur? Does it occur on the day that we make the deal? Does it occur on the day that they receive the package, right? So trying to look at and research what those rates might be in the future is also a pretty solid investment strategy, or at least a strategy to try to avoid losing a whole lot of money in a deal. So in this video, we learned about how strong currencies or weak currencies may affect your prospects for success when you enter an overseas market. This is profoundly important, but it's also important to look behind the causes, right? What's causing a currency to become strong? What's causing a currency to be weak? And can you make predictions on what's going to happen? And that's where some of those other videos that I made would be of particular use to you, right? If you look at a country and it looks like the government is spending a lot of money, right? That's going to increase the money supply. That's going to cause that currency to become weaker. And then that's going to affect your decision for whether or not you ought to go into that country. Also, if there's a lot of erratic policies, erratic money supply, right, then maybe you can't count on the value of that being something that is going to be worth your while as far as making that investment. So please keep all of this in mind as you make your business plans and contemplate global expansion. For Beyond Profit, Global Perspective, this is Mark, and I'll see you next time.